Hello, welcome to my new channel. This channel is also for educational purpose, and I'm going to mainly focus on various topics of investment, and they mainly will be in the stock market. I also plan to touch base on the topics like real estate investment. But again, if you are investor and trader and you are interested in investing in stock market and also thinking about investing real estate, then this channel should be for you. And don't forget to subscribe, and I plan to push out weekly videos for you. So give me some feedback by writing the comment down below. In this video, I'm going to talk about dollar cost averaging. Dollar cost averaging as a mostly recommended strategy by experts or financial advisors. So what is dollar cost averaging, and does that really work? And what is the alternative approach, and is there any better approach for you? And we're going to talk about in this video. Stay tuned. Let's say you have $1,000 to invest in the stock market. You could just buy $1,000 worth of stocks on the same day, and then just hope it will go up. Or you probably thought, right? You probably think the smartest thing to do is to be able to buy at low and sell at high. But the problem is, how do you know when it's low and when it's high? We all know, right? The stock price movement, they are not in the straight line. They go up and then go down a little bit, go up and go down. People wanted to time the market. If they could do this 100% of the time accurately, then they can optimize all the gain. But you have to be able to time perfectly at the low and time perfectly at the peak, and then repeat the same process, and that's impossible. And if you don't know what I'm talking about, I would recommend you of this book, A Random Walk Down Wall Street. This is one of the best books I have actually read in the topic of stock market investment. And if you have not read this book yet, the main idea basically is about the stock price. They are pretty random. It's the key message is it's impossible to time the market perfectly. Let's say if you get lucky and just be able to buy at a low at one point, right? But you missed to sell them at high, because you thought it's gonna be higher, and then it went down, and it went down to the lower point that you bought, right? Or it could be the other way. So basically, if you really want to optimize all the gain, you have to timing the market perfectly, and which is impossible. So that's where the dollar cost averaging strategy came in. That basically just says the assumptions we don't try to time the market anymore, and we, instead of trying to time the market or just buy the stock at on the same day, which there's another term called a lump sum investment strategy, which I just talked about. We use this $1,000 and buy $1,000 worth of stock on the same day. And instead this approach, lump sum approach, we could do dollar cost averaging. That means we actually divide this $1,000. Let's just to be specific. Okay, I give you an example. I wanted to invest it in terms of 10 months. Okay, then what I do is at the beginning of each month, I invest $100 out of this $1,000 and buy $100 worth of stock on the first day of each month. And then I repeat it for 10 months until I used up all this $1,000. And next, I'm going to use the stock chart of SP 500. I will use its ETF, SPY ticker symbol, to show you the advantage, pros, and cons of dollar cost averaging, give you a specific example and the chart, and walk you through why you probably want to consider dollar cost averaging, and in what cases you probably want to think about lump sum investing, or is there any other approach? Market can go three different directions. There's three possible scenarios. First is the bull market, which means the general trend is go up. And the second scenario is bear market. The general trend is going down. If you think about, this
period of time. And the third scenario is the market is going flat. And all of these are possible. Let's take a look at the SP 500, the overall. Here is from like 19 all the way 1928. Okay, from this particular screenshot window is up to 1953. So we can see in this period of time, the market is kind of flat, right? It's basically going up and down around here, this line. And so if the market is flat, and this actually is more than, it's around 30 years period of time. If you do lump sum investing, let's say if you, in the worst scenario for you is you invest here at the peak, right? And after 30 years, you still losing money. And so that's why dollar cost averaging is better, because you just invest every, period of time. And let's say it's either 1 month, 1 week, 1 year, 3 months, doesn't matter. So just you pick a time. I think a lot of people do is every single month, right? Regardless of the price, then you put a certain same amount of money to invest. That's dollar cost averaging. If you do that, you can actually averaging your cost basis through all these 30 years, then you can get a much lower cost basis than you do lumping some investment here. But of course, if you get super lucky, if just imagine you happen to do lump sum invest at this point, then of course you actually make more, right, than dollar cost averaging all along here. So what I say is if you use lump sum investing in the flat market, it's not guaranteed. How you do it, depending on in which point you invest, right? But in using dollar cost averaging, in general, you can lower risk. And what about the other period of time? In other scenario is the bull market. The trend is in general go up, although you can see once in a while it would correct a little bit, but it would around a line, straight line, which is going up. And here's an example from 1950 to 1970 is pretty much a uptrend market. And for here, as long as, right, if you start doing lump sum investing before like midpoint, like 1960, you're probably gonna be doing better than or not worse than dollar cost averaging, from 1950 to 1960, let's say. At this point, you definitely it's better using dollar lump sum investing rather than dollar cost averaging. The reason is because it's general uptrend. So the sooner you buy, the more you gain in terms of profit. Now let's look at the bear market. In this, where I found two bear market scenario, which are short-lived. One lasts 3 years, from 2000 to 2003. Another one is from 2007 to 2009. Pretty much in this window, it's strictly the market stock price is going down. And bear markets tend to be short-lived. The average length of bear market is 289 days, or about 9.6 months historically. And that's significantly shorter than the average length of a bull market, which is about 2.7 years. And in the bear market, here we can only see very short window. Then we know the lump sum investing probably is in the worst case scenario for that. Because you tended to invest at the top and then have to endure all the pain, and a dollar cost averaging can help you lower the cost basis. And overall, the entire stock market in the past 100 years, we can say it's generally in uptrend. So I would argue, if you have a very long investment horizon window, then probably it is good, always good to invest as soon as possible. But if with the help of some research of the market condition to make sure it's not in this worst case scenario for the lump sum investment, like from 2000 to 2003 or from 2007 to 2009. Other than those small windows, then probably it actually surprisingly makes more sense to use lump sum investing rather than dollar cost averaging. To summarize, if we are in the bull market, then using lump sum investing makes more sense than dollar cost averaging. Other than that, if we are either in the bear market or in uncertain market or the market goes sideways, then in general, dollar cost averaging makes more sense. So if you really don't wanted to worry about anything, then I would still suggest use dollar cost averaging. In that case, you don't have to do any type of research. Or if you wanted to challenge yourself a little more, wanted to squeeze and optimize the gain for your performance, then I would encourage you to do a little bit of market research. If you think the probability is much higher that we are still in a bull market, then I would suggest to use lump sum investing all at once.